Thank you. So great to be here again for the Morningstar conference again this year, and to have the opportunity to tell a little bit about Resolution Capital, how we invest in global listed real estate, some of the opportunity we see in the sector at the moment, given the solid underlying fundamentals for the sector. I'll take a little bit of a look at portfolio positioning, and then one of the key sectors within the portfolio, healthcare real estate, through the lens of Ventas, so one of the largest positions in the portfolio. So for those of you less familiar with Resolution Capital, we are a global listed real asset manager. So we manage portfolios of global listed REITs, which is the vast majority of our AUM, also listed A-REITs. And then over the last 4 or so years, we've launched the listed infrastructure capability. So we have listed ETFs, RCAP for the listed REITs, RCAP, and RIF, RAAF for global listed infrastructure. Now, in terms of how we invest in global listed real estate and how we view the universe, it's really been a consistent approach since the inception of the firm. We very much view listed real estate as a way to access really high quality real estate in major markets around the world, where you can get access to whether it's different property sectors, different locations that domestic investors would find hard to do so. And that can range from areas with longer term secular themes, such as healthcare, which we'll explore later, through to things like data centers, cell towers, and then into the more traditional sectors such as retail, rental housing, etc. But for us, global listed real estate provides Australian investors with diversification from the Australian economy, so a little over 6 or 7% of the portfolios in Australia, and again, access to a really compelling opportunity set for global listed real estate. In terms of the opportunity we see in the sector today, clearly it's been a difficult period for listed real estate and indeed institutional quality commercial real estate in many markets around the world. But we think a lot of that has now largely washed through. We've seen that values have bottomed in many developed markets, and that's after an adjustment of anywhere from 10 to 20% in values. If we look at the US, UK, and Europe, it's sort of more in that 20% range, and a little bit less in other markets where they didn't have such a significant increase in interest rates. And that's been the main factor which has caused an adjustment for many property sectors. There has been others where there was COVID-induced supply. We'll come back to that. But by and large, we've seen values bottom, and they're actually now inflecting up in many markets. And that's been driven predominantly by rental growth. And that's been different this cycle in that the majority property sectors, you are seeing growth in rents and cash flow, and that's now starting to flow through into underlying property values. But what's critical for real estate and real estate returns, and why we see the sector as being pretty well positioned in this sort of environment, is the balance of demand and supply continues to be pretty favorable for many sectors of the real estate market. So when we look at supply, typically we do that by property sector and obviously by regions, but really there hasn't been an oversupply this cycle as there have in many. There was some COVID-induced supply, particularly in life science, logistics, real estate, and also Sunbelt apartments. And as you can see here on the light blue line, supply as a percentage of stock has really started to come down. And that's continuing. And we see the dynamics such that we expect that to continue in the near term due to the elevated replacement costs. And I'll come back to that in a second. So supply has come down substantially, and it really is helping to underpin the outlook for rents for the sector. In terms of demand, we're looking at pretty high occupancy across the vast majority of property sectors. Yes, it's come off a little bit in terms of this chart here, and that's really due to the US office market. But when we look at some of the key sectors within the Resolution portfolio, whether it's healthcare real estate, residential real estate, rental, retail real estate, you've got very high occupancy with growth in rents and cash flow. So the demand and supply picture continues to be pretty constructive for the listed real estate sector. And what we think will help underpin those rents over the next 3 to 5 years has been a significant increase in replacement costs. So the chart we're showing you here highlights the growth in commercial real estate values over time, and also the change in replacement costs in that dark blue line. And replacement costs have been up, so the physical cost to build new buildings anywhere from 30 to 40% over the last 4 to 5 years. And that's happened in an environment where property values have come down by the order of, as I said at the start, around 20% in many markets. So what that means is the cost to build new buildings is often, in many cases, higher than in-place value. So it's just not economic to develop. And that's what's driving that reduction in new supply. And if anything, in this environment of elevated uncertainty due to tariffs and other policy issues, that's likely to continue to reduce that appetite for developers to bring on new supply, both through the cost inflation of tariffs and just some apprehension to invest capital at this point in time. So we do see this replacement cost dynamic underpinning rents for the sector. It also means that the values and rents for existing real estate need to increase to those economic levels before you'll see that supply cycle restart. And again, that helps to drive the rents and values for existing real estate. Now, given that setup in terms of the demand and supply balance, we are seeing healthy operating conditions for those real estate sectors within the Resolution portfolio. And that's things like healthcare real estate, data centers, cell towers, through to residential and retail real estate. And the chart we show you here shows you the NOI, the net rent forecasts for the Resolution portfolio by sector, and then also the underlying earnings growth that we expect over the next couple of years. So a little over 4% in terms of net rents, a little over 6% in terms of earnings growth over the next couple of years. So pretty healthy expectations for underlying earnings returns for the portfolio over that period. Now, turning to some of the valuation metrics, we've been highlighting for a while that we think the sector is undemanding on an absolute and a relative basis, and also in an environment that we're in now where there is a greater degree of volatility. I think this is where real estate cash flows really start to shine, and that is because you do have that contractual nature, which you have lower volatility than other businesses. And we've seen that through time, as you can see over this longer term chart here in terms of the relative volatility of REIT earnings versus equities. So if we do see a more disruptive period, then the resilience of REIT income should help to provide that more sustainable return profile. Again, the returns are underpinned by healthy dividends, so a little under 4%, and that is well cash covered with some of the lowest payout ratios we've seen in some time. In terms of valuations, compared to broader equities, one valuation metric, the sector's rarely been this cheap outside of COVID or the GFC. And again, the underlying replacement cost dynamic we think underpins those values, given the physical cost to build buildings is quite elevated. Turning to underlying net asset value, another valuation metric, the sector is clearly trading around a 20% discount, so cheap to those underlying net assets. And that's after values, again, have corrected in the order of 10 to 20%. So another undemanding valuation metric for the sector. Now, turning to portfolio positioning. So in terms of the overall composition of the portfolio, a quick snapshot here in terms of absolute sector exposures, and then in terms of relative, so the active positions. So the largest investments being retail real estate, healthcare, residential, and those are also the largest active positions versus the benchmark, if you will, where the team has the highest conviction. Where we still have less exposure and active positions against, so underweights, industrial, given the supply still being absorbed, particularly in North America, some of the tariff uncertainty maybe elongating the hope for recovery in that segment. Also office real estate and hotels. When we look at it on a regional basis, we have around 60% of the portfolio in the US, and we had reduced around a 5% of that prior to the tariff announcements in early April. So that was also driven by really just bottom-up valuation and looking for other opportunities. So the largest active positions in the UK and to a lesser extent in Australia. Now, turning to healthcare real estate and Ventas, so one of the key sector exposures within the portfolio. This is a rental seniors housing portfolio, different to what you have here in Australia, in that it's a simple cash rent model. Resident moves in and pays rent for their care and accommodation. It's a segment which is benefiting from the recovery coming out of COVID, so very strong growth in occupancy in rents. And when we look at over the next 3 to 5 years, it is a segment which is, one, less economically sensitive, two, not exposed to tariffs or government policy changes in the US, and three, underpinned by very powerful demographic trends. So the over 80s population going to grow at over 4.5% compound well past 2030. So Ventas is enjoying the growth in that segment of its portfolio. So that senior housing operating portfolio is about 40%. And then also supportive dynamics in terms of outpatient medical and some of the other segments in terms of seniors housing in the triple net segment. So when we look at the supply side as well, so very strong demand, pricing power in terms of rents, growing occupancy, you have a supply cycle which has really collapsed. So some of the lowest net supply growth in seniors housing we've seen for many, many years, just as you've got that demographic tailwind coming. And that sets up a pretty powerful multi-year period for this business to grow rents and cash flow, again, in a less economically sensitive real estate type, which is not exposed to those sort of government ructions in the US. We expected to compound earnings at over 10% over the next 5 years, particularly given that supply and demand dynamic that we've outlined. So turning to the outlook and wrapping up some of those themes that we've discussed, we do think the sector is in a sound position to provide effective diversification within a broader portfolio. It's underpinned by strong demand and supply fundamentals. Elevated replacement costs mean that new supply is uneconomic for many property sectors, and that will also help to drive rents and cash flow over time. In some sectors, given the volume of supply or lack of supply rather, we do see the prospect for increases in rents and even rent squeezes in some cases. It's less exposed to some of the tariff noise and ructions going on, and the capital structures help it to withstand this volatility in capital markets. Low leverage, around 30%. So we do believe with the sector priced around intrinsic value, it's earned its role in a well-diversified portfolio. Thank you. I appreciate the time.